Hey everyone, welcome back to the Mortgage Market Minute. I'm Chen with Simple Mortgage, your licensed mortgage broker here in California. Every week, I break down what's happening in the mortgage and real estate markets so you can stay informed and make confident decisions. Today is June 25th, 2026, and we've got four big topics this week. Mortgage application volume, the Federal Reserve's latest decision, how global events are moving your rate, and what today's market really means for buyers. Let's get into it. Quick note before we start. Everything I'm sharing is for educational purposes only. It's not financial, legal, or mortgage advice, and rates and programs are always subject to change. For guidance specific to your situation, please talk to a licensed professional. According to the Mortgage Bankers Association Seasonally Adjusted Index, total mortgage application volume fell 3.8% last week compared to the previous week. Refinance applications dropped 5% week over week, and purchase applications dropped 3%. Now, those numbers sound negative, but context is everything. Compared to the same week 1 year ago, refinance applications are actually up 17%, and purchase applications are up 3%. Why? Because a year ago, mortgage rates were nearly a quarter of a percentage point higher than they are today. So while the week-over-week numbers dipped, the year-over-year trend is moving in the right direction. The weekly pullback is largely tied to mid-week rate volatility, which brings us to our next topic. At the most recent FOMC meeting, the Fed unanimously voted to hold the federal funds rate unchanged. No surprise there. But here's the part that rattled markets. More Fed voting members now project that the policy rate will be higher at the end of 2026. That's a shift toward what we call a hawkish stance, meaning the Fed is signaling it may need to raise rates later this year if inflation doesn't cool down. When those projections were released, bond yields spiked and mortgage rates briefly jumped before settling back down the next day. Here's why that matters for you. The Fed is focused on price stability right now. Inflation is projected to stay elevated in the coming months, and the labor market is holding steady, which means there's no pressure on the Fed to cut rates. Their priority is fighting inflation. This is also the first FOMC meeting under new Fed Chairman Kevin Warsh, and markets are watching his tone and forward guidance very closely. Any signals he gives about the rate path ahead will have a direct impact on mortgage rates. Broker insight: when the Fed signals rate hikes, mortgage rates can respond quickly. If you're actively shopping or planning to make an offer, having a rate lock strategy in place matters right now. Here's what happened this past week. CPI inflation data, the Consumer Price Index, came in higher than hoped. That pushed mortgage rates up early in the week. But then, by the end of the week, growing optimism around the opening of the Strait of Hormuz, tied to U.S.-Iran peace negotiations, pushed oil prices down, and when oil prices fall, mortgage rates tend to follow. According to Mortgage Daily, rates are now at their lowest levels since May 14th. But there's an important caution here. U.S.-Iran peace talks have been delayed, and key details of any agreement remain unspecified. Some analysts believe oil prices may have already gotten ahead of the actual news, meaning if peace talks stall or reverse, rates could spike back up quickly. Mortgage rate volatility is expected to continue in the weeks ahead. Broker insight: in a market this unpredictable, options like a float-down provision or a shorter lock period can give you protection while keeping some flexibility. It's worth having that conversation before you're under contract. What buyers are actually up against right now? The honest answer is three things at once. First, mortgage rates. At 6.60%, affordability is still a real challenge for many buyers compared to just a few years ago. Second, housing inventory. Supply remains lean in most markets, which means fewer homes to choose from and continued competition, keeping prices elevated. Third, economic uncertainty. Between inflation data, Fed signals, and ongoing geopolitical events, some buyers are simply hesitant. But here's the message I want to leave you with. Buyers who are prepared are still closing on homes. The year-over-year improvement in purchase applications, up 3% versus this time last year, tells us the market is adapting. Sellers still have pricing power due to low inventory, but well-prepared buyers with pre-approval in hand and a clear strategy are competing successfully. Mortgage programs exist for a wide variety of situations, including options with lower down payments for first-time buyers. The key is being ready before the right home hits the market. To wrap up this week, mortgage application volume dipped 3.8% week over week, but is ahead of last year on both purchase and refinance. The Federal Reserve held rates but is signaling potential hikes by year-end. Global events, specifically the Iran peace negotiations and oil prices, created midweek volatility but pushed rates to a recent low by week's end. And buyers continue to navigate high rates, lean supply, and economic uncertainty, but the market is moving forward. If any of this raised questions about your specific situation, whether you're a first-time buyer, a move-up buyer, thinking about refinancing, or just trying to understand your options, I'd love to help. Give me a call or email me. Follow Mortgages Simple on Facebook, Instagram, YouTube, X, and LinkedIn for weekly updates like this one. All the links are in the description below. Thanks for watching the Mortgage Market Minute, and I'll see you next week.